Alright guys, in this video we'll have a quick chat about the concept of dollar cost averaging and how it can be a useful strategy to employ for many investors. So the whole premise behind this is to remove the stress and the chance of making an error when trying to time the market, because really in the long term it's not about trying to time the market but more about time in the market. So you want to stay invested. Over the long term, it's not going to matter so much whether you bought when the stocks were on a high day or a low day. The most important thing is keeping your money in the market working for you over a long period of time. That's where you get compound gains from, and then where you are able to use that to grow a nice portfolio for yourself. So unless you're a professional or you have a lot of time to sit, analyze and monitor the markets, the chances are you're not going to be able to get in at the right time every time. No one really knows what the markets are doing from one day to the next, not even the Federal Reserve, not even the Reserve Bank of Australia. Many of us who have been investing for a period of time know that when you try to outsmart the market can often make a fool out of you. What I mean by this is trying to time the market, trying to buy low and sell high. It's very hard to get that right. So if you want to take that risk of buying at the wrong price point, or even the stress of buying at the right price point, if you want to remove that from the equation, dollar cost averaging is an excellent way for investors to drip feed money into the market to ensure that over a period of time, you get a good average buy-in rate. So how it works is if you have a certain amount to invest each month, let's say you got $2,000 to invest every month. That means every month, like clockwork, after you get paid, or you can do it fortnightly even, or weekly, it's up to you if you've got enough money to put in. You make investments at regular intervals, monthly, week, whatever it may be. You put in the same amount at the same interval over a period of time. So I'll put in, say, $2,000 on the 15th of this month. Next month, I'll put in another $2,000. The month after that, I'll put in another $2,000. You just keep going like that. You keep it regular and you keep it going, and then over the longer term, you are going to get a good average buy-in rate if you keep it going long enough. It's not to say that if you have a bit of extra money one month that you can't throw a bit more in, or if the market has been particularly hammered in another month, you might want to throw a bit more in. You can still do that. The most important thing is that you are putting something in every month or at this regular interval, whatever you're working on, monthly or fortnightly or weekly. You're putting money in at regular intervals over a long period of time. That is the most important thing. So this month you might buy a particular stock at $25 a share. Then next month the price might go up to 27 and you buy them at 27. Then the month after that, there might be a bit of a correction in the markets and it might drop down to 20 and you put in money there as well. So what you're doing, you're averaging out your buy-in price over a period of time, so you don't have that risk of throwing a lump sum into the market at one time and potentially getting a bad price. This is good for average Joe investors, but not just that. It's good for anyone. If you don't have the time to analyze markets, to keep tabs on what's happening at the prices every day and throughout the day, if you're not a professional in analyzing stocks, this is a good strategy for you. Even if you are a professional, it's still a good strategy to do this to a point to cover some of that risk in case your analysis turns out to be wrong. It takes the emotion out of it. It takes the worry out of it. If you're thinking, oh, look, I don't know if I want to put money in now because the prices look a bit high, but then if it turned out that the market was just at the beginning of a bull run and you really should have put money in, this strategy will force you to put money in regardless of how you feel about it. It will also reduce FOMO, or getting caught up in market hype. When people are talking about the markets and particular stocks on social media, everyone's talking about it, everyone's throwing money in. You can have a bit of irrational price growth. This can create a bubble in a stock that can then pop, and then the price can then fall back down to earth. You don't want to get caught up throwing huge amounts of money into something just because everyone's telling you to do it online. That is a mistake. I'm not saying that that is a reason not to put money in, but what I'm saying is dollar cost averaging will force you to spread your money out rather than throwing all your money in when you feel there's too much hype in the market and everyone's pushing you and you have pressure to buy, or you're going to miss out on gains. It forces you to not do that, but more to spread it out over a period of time, month after month after month. You're buying stocks in the good times, you're buying stocks in the bad times, and you get a good average price over the long term that you can then build on to grow a nice portfolio. The thing with trying to time the market, There have been studies done on this that some of the biggest gains in markets, in stock prices and like the All Ordinaries or the ASX 200, whatever it may be, they happen on particular days. So it can be a big swing day or a couple of big swing days. And if you're not invested, if you haven't bought in prior to that big swing, you're missing out on these big gains that could have been very beneficial to the growth of your portfolio. When you dollar cost average, you're not missing out on any big swings that happen on particular days, because it guarantees that you will participate in some of that market upswing because you were already invested last month, the month before that, the month before that. All of these shares you bought are now participating in this big market swing that you may have missed if you're going to put a lump sum into the market at one period of time. This doesn't stop you from having a bit of play money, having a bit of speculation money to throw money into sectors that you believe are going to perform well. Think of it as kind of an insurance policy. It's going to save you from yourself, save you from market hype, and ensure you get a good average buy-in rate over a period of time. It's insurance for your investment portfolio, insurance for your future, insurance for your retirement. Now, if you're interested in learning more about how to allocate your money to various sectors, various stocks, various ETFs, we have an asset allocation template up on the website that is available for a free download. You can go to onmoney.com.au to find that. I'll put a link in the description. You can use this template to show you where to put your money into what sectors. Some sectors might be performing better than other sectors. Some asset types might be performing better than other asset types. The asset allocation template shows you how to do that. There is also a video that we made on how to use that, so I'll put a card up above regarding that. Apart from that, guys, that's it from the video. Happy investing. We'll catch you later.